Hi, I'm Ben Reppond. Today is Wednesday, November 23rd, 2022. Welcome to my YouTube broadcast. I'm going to cover the stock market and bond market and the direction. I'll do that through dashboards and through charts, and then the metrics from Asbury Research. So a lot of different perspectives to show you what's going on and where we've been, and give context to the markets. We'll begin with the dashboard. This is covers the major indexes plus bonds. It goes from the Dow Jones Industrials, the S&P 500, the developed markets, and Russell 2000, emerging markets, and NASDAQ 100, all going down like that. And then at the bottom, the bonds, the 20-year long-term government bond, ETF, TLT. And there are 4 columns of numbers, and the far right column of numbers is the year-to-date percentage, in this case loss. Everything has lost money. So it's the loss from the Dow, which is the least, and to the one which has lost the most, which is the 20-year government long-term bond, ETF, TLT. And so it'll show you, going from left to right on the numbers, the last week, last month, last quarter, and year to date. And then on the far right will be, these are kind of dashboard indicators showing, is that index above its 20-day, 50, 100, or 200-day moving averages. So if they are, they get a green dot. If they are below those averages, they get a red dot. Green showing more strength, and red showing probably more weakness. So they go from the top, the Dow Industrials, down about 7% for year to date, S&P down about 17%, and going all the way down to the next to the last row, and that's the NASDAQ 100. It's down 28% for the year. Still, a lot of portfolios are down 20% plus, because bonds are down so much and equities are down, at least in the teens and sometimes even in the 20s. But when you put the two together in a typical portfolio, it's not uncommon to see those losses still at 20% or more. Next is this is the sector dashboard showing the 11 sectors of the S&P 500. There are 33 dots that are green. Last week there were 34. It's down just a little bit this week in general, and there were potentially 44 green dots, or 44 spaces, and we've got 33 of them that are green. So that's more of a positive sign than it has been in past weeks. And then it shows just like the previous chart, the last week, the last month, quarter, and year to date. I focus on the year to date, just to give you perspective. Energy, oil companies are way, way up, and you know that from gas prices. And with the ETF, XLE, has had a gain of 63% year to date. Wow. Everything else has lost money, from minus 3% all the way down to consumer discretionary, which is down 31%, and everything else is in between. This is a chart showing the S&P 500 represented by the ETF SPY over a 12-month period. It's a weekly chart, so one move in this line, up or down, represents 1 week. So it gives you a little more of a macro perspective than a daily chart would give you. And then I draw a black line showing the general trend is still down. And what cuts through the middle of that is the blue line, which is the 20-period moving average. Now, it's a moving average on 20 weekly periods. So the next chart is a ratio chart showing that inside the S&P 500 are growth companies, growth stocks, and value stocks. Growth companies focus more on revenue, sales, and value companies focus more on profitability. But they're both part of the S&P 500. So you can see in a ratio, this would be relative strength actually, SPY-G, the ETF for growth companies, is the numerator, SPY-V is the denominator, and if it goes up, that favors growth companies. If it goes down, that favors value companies. You can see the general direction over the last year, this 12-month period of time, so this would cover late November to late November. And you can see that the value has continued to be mostly in favor that entire period of time, with some short-term adjustments in, let's see, June and July. The growth came back into favor, but then it collapsed, and the value has primarily stayed in favor. This is a chart, same thing, it's a ratio chart. I expanded out to 24 months, and it shows the small cap companies, smaller companies in the stock exchange, as a numerator, and the larger companies, the S&P 500, as the denominator. So if it goes up, that shows that smaller companies were performing better than larger companies, or the Russell 2000 small cap index, the ETF is IWM, performed better than SPY, which represents the 500 largest companies. At the bottom, at the right end of the chart, I'd put a black arrow in there to show you that in general, over that, this is since end of January of 2022 until present, it has a slight increase to it. It goes up and down, but in general, it is starting to favor small companies a little more, whereas prior to that time, you can see that when it came down, that was favoring large companies. So it goes back and forth, but I'm starting to see smaller companies emerge a little better. Or I should say it this way, they are going down less. They're all going down, but they're going down less. Okay, then I get away from the relative chart and go to an absolute chart. And this is the 20-year government bond ETF, TLT, and it has, for approximately this past year, been in a downward direction. And I show that with the black arrow at the right of the chart. And you can see, relative to nothing, just by itself, 20-year government bond has declined a lot, and so has the intermediate term bond and the short-term bond. They've all gone down a lot. And why is that? Because interest rates have gone up and bond yields have gone up. They tend to track together, and what that means, that's inversely correlated to the price of the bond itself or the ETF, and that's going to create generally speaking, a downward direction in the bonds and in the bond funds or bond ETF. I covered the US dollar. The dollar has been strong against all other currencies. You may say, well, the dollar has been weakened because of the printing of money. Yes, but relative to other currencies, they're in worse shape than we are. That's another way of saying it. So it has been going up, but then recently it has come back down and come down below its 20-day moving average, or excuse me, 20-period moving average. This is a weekly chart over an 18-month period of time. So it's now broken below that, and I would say when it does that sharply, it probably has more downside to it. So I would expect the dollar to probably be weakening relative to other currencies in the coming weeks and months. This is a chart, 48-month chart. So this is 4 years of data for GLD representing gold. And this is an ETF. And you can see for a little over half of this period of time, which means a little over 2 years, that gold, generally speaking, has been in a declining mode. Even though on the far right of the chart, it has gone up above its 20-period moving average. The general direction is still down. It has not really changed. It's gone up lately, but it has not really changed the long-term direction, which is still down. Same thing with silver. It's broken above the 20-period moving average, but still over the last 2 years plus, goes back to about last August when it peaked. You can see the general direction is still down. Then I put a ratio together, a 24-month chart, weekly chart, showing that silver as the numerator, gold as the denominator, or SLV is the ETF, divided by GLD. And so if it goes up, that favors silver, and if it goes down, then that favors gold. If they've both gone down, then the one that goes down the least, if GLD went down less than SLV, then it would go down. And that's what's happened. Gold and GLD have been less damaged than the price of silver or the ETF SLV. And then I put in the volatility index, the VIX, VIX, which is an index that tracks volatility. And when I say volatility, it's not generally for this to go up, that what that means is not up and down volatility. It means downward pressure in the stock market is going to tend to push this up, and vice versa. So put the arbitrary line at 24, and generally speaking, if it's below 24, that's favorable for equities, and but this last week was slightly negative for equities, and so you see a move up in the VIX. It's not surprising, but it is still below that arbitrary line of 24. Asbury Research this is through last Thursday, and I recorded this prior to Wednesday, so I don't have all of the data, but I can show you this. And through last Thursday, there were 5 of the 6 metrics that Asbury Research tracks that were positive, and only 1 that was negative. We give you the spot price of silver and gold. This is the price before they add a commission to it, or a premium, and this is as of Friday and the 18th. And gold, the price is $17.53 for an ounce, spot price. That's down 1.2% from the previous week. And then silver is $20.95 per ounce, and that's down 3.9% from the previous week. So I hope you have a happy Thanksgiving. Enjoy a meal with your friends and family, and be grateful. Be grateful what you have. I'm grateful for what I have, and no matter what the problems or challenges are that you face, it's better to approach this time of year, and actually every day, with a feeling of gratitude. This is an artist's rendering of the first Thanksgiving, and the Pilgrims landed at Plymouth Rock in Massachusetts, and they held this first Thanksgiving in 1621 and shared a meal with the Native Americans. And they know that from the writings of Edward Winslow that recounted this. And I believe I read that they had 90 Native Americans. This just shows a few, but there were 90 Native Americans that they invited to join them for a week-long feast, and being thankful for the harvest that they had that year. So this is a season for especially setting aside this day and being grateful for what you have. So thank you for watching. If you have any questions or comments, leave them in the comments section below, and I will try to answer them. Thank you again for watching. Happy Thanksgiving.